Good morning and welcome to this month's Oakcrest Insight. This month I want to talk about something that we're having many conversations with now on with clients. The benefits of higher interest rates for your personal finances. Now, the Federal Reserve just raised interest rates again, 75 basis points this past week. Their mandate, as set by Congress, is to keep prices stable and to maximize employment, right? So in simplistic terms, how does this work? Well, they raise rates when the economy starts overheating or too much inflation, like the past year, and then they cut rates when the economy looks weak or high unemployment, like in 2020 during COVID. Since March, the Fed's main concern is to combat inflation, and they've raised rates 6 times so far, and here's a graph kind of showing you that. Now, interest rates affect the big picture of our economy, but they also have a tangible effect on our personal finances, right? Such as student loans, car loans, mortgages, savings accounts, and more. So what you hear every day on the news or media is how rising interest rates have a negative effect on us, right? They put mortgage rates close to 7% now. Car loans are higher, student loans are higher, credit card interest rates are higher. But one thing that also is higher now is places for money that you don't want to take a lot of risk with. Right? So here's a graph of interest rates going back to 2000. Now, this graph illustrates something I talk every day now about with clients. Last 15 years, interest rates have been extremely low, close to zero, sometimes at zero. So not since 2007 or before that 2000 have they really been this high. So if you're looking to get a mortgage now, unfortunately, you're going to be paying a little bit more in interest, right? But think about, over the last 15 years, how many times you've looked at your bank statement or CD statement and said to yourself, wow, that's all the interest that I'm getting on this? Well, it's because rates have been so low. Now, if you have money in the bank or money markets or CDs, you're now going to be able to get a meaningful interest on those assets. So think about a year ago. CD rates were under 1%. The interest you're receiving in your savings account, really, what was that, maybe a few dollars a year? Now fast forward to today, right? Things have changed. The Fed's raised rates 6 times. Here's the benefits of higher interest rates, and we don't expect them to come down for a while. So as a disclaimer with these numbers, this is not every bank. They could change, and it's just an example of some options that are out there for Americans. Now, let's look at money market accounts, right? Today, there's some I've seen around 3%, when in February, this was 0.1%. On $50,000, that's close to another $1,500 more in interest a year compared to a year ago. Less than 1-year CDs, I've seen between 2.5% to 4%, depending on banks. 1-year Treasury rates, right, as of November 2nd, were 4.76%. I bring this up as the last 15 years, clients had to take some risk for money that they really wanted to keep out of investing long term, right? They wanted to be conservative with it. Now with rates higher, you have potential to keep money in these areas and get more interest than you've been used to. So many banks haven't caught up, right? Because interest rates have gone up so quickly. But there are some institutions out there that have. So I hope this helps as you think about your situation in a discussion we've been having more and more with clients the last few months, right? We look forward to seeing you next month on Oakcrest Insight.